Thanks so much for joining us. A real pleasure to have with us for this session of Best Ideas 2014, Chris Swasbrook, Managing Director and Portfolio Manager of Elevation Capital Management based in New Zealand. I've known Chris for a few years now, and I'm very excited to have his perspective at this conference. Although based in New Zealand, Chris is a global investor and has a keen eye for finding value investments across different geographies and market capitalizations. So the fact that he's presenting on a U.S. company here, as you can see on the slide, is perhaps telling in terms of the value opportunities Chris sees around the world today. Before I turn it over to Chris, just a couple of words on his background. Before co-founding Elevation Capital in 2006, Chris was a partner at Goldman Sachs' affiliate in Australia, where he was in charge of the institutional equities business. Over the years, Chris has also built up a fund of funds business at Elevation Capital, through which he invests with some of the world's best value funds, including the Sequoia Fund, Third Avenue Funds, and International Value Advisors. And with that, Chris, I'd like to turn it over to you for your prepared remarks. Please go ahead.
Thank you, Oliver. Thank you very much for having me present at this conference. As you can see from the cover slide, I am going to talk about a NYSE-listed company today called Post Holdings, and a stock in the consumer staples sector that we think offers interesting opportunity for investors leading into 2014. With that, Oliver, if we turn to the next slide, slide 1 and 2, which is the disclosure statements. Please, everyone, read these disclosure statements and take the time on them. I won't dwell on them for long here, and if we could shift attention to the slide number 3, where we are going to talk about the history of Post Holdings, and it is a long and storied history. Post begins its life in 1895 when Charles William Post founded Post and Cereal Company in Michigan. Mr. Post was actually a protege of John Harvey Kellogg, and inspired by Kellogg, Post created the grain-based cereal beverage Postum as a healthier alternative to coffee in 1895. Post then debuted his ready-to-eat cereal, Grape Nuts, in 1897, followed by a cornflakes product called Post Toasties in 1984. Post grew rapidly over the ensuing decades as cereal gained in popularity, and the company began to expand into packaged food via a number of acquisitions. Post acquired General Foods in 1929 and adopted the General Foods name at that point. They were ultimately acquired by Philip Morris, now Altria, for $5.6 billion in 1985. It was actually the largest non-oil company acquisition in US history at the time. Philip Morris then merged General Foods with Kraft after purchasing the latter in 1989. By 2007, Kraft was completely spun off from Philip Morris, and it announced it would sell Post cereals to private label manufacturer Laureate for $2.64 billion. That transaction was structured as a spin-off merger. And then we fast forward through to 2012, and Post Foods has come full circle, having been spun off by Rail Corp and was listed on the NYSE on the 7th of February 2012. So a long history. If we turn to slide 4, it's a history built over 117 years. I guess the time continuum that I show here is the evolution of Grape Nuts, which is clearly a very stable product, still around after 117 years. On the bottom of the continuum, clearly a whole lot of companies that have come and gone over this this time. This is a very stable business, the core cereal business of Post Foods or Post Holdings. That's what I'm trying to highlight with this slide. If we move to slide 5 and just look at some of the brands within the cereals business, one has to remember with cereal, it is a core staple for consumer and drives shopping frequency, making it a key centre of store, highly promoted destination category for food retailers. If we look at the brands, Honey Bunches of Oats in the top left-hand corner is the 4th largest brand of ready-to-eat cereal in the US with a 4.4% dollar market share for the 52-week period ended 28th of September 2013. If we move to the next one with Fred Flintstone on the front, Pebbles was launched in 1971 and has been a strong performer in the sweetened category with a 1.8% dollar market share over the same time period. But again, I'll come back to grape nuts. I mean, this is a product that is still around since 1897, and management actually does note that they could do more with grape nuts, improve the marketing and things like that with that product over time. So a really interesting brand suite within the cereals business that new, reinvigorated management could do something with, in our opinion. But those brands, if we turn to slide 6, have resulted in Post being the number 3 cereals player in the US with a 10.4% market share. Kellogg, number 1, General Mills, number 2, Quaker Oats, owned by PepsiCo, number 4. The US ready-to-eat cereal industry has approximately a 92% household penetration. So as I said, it does drive foot traffic into supermarkets. Scale and brands are a significant barrier to entry in our opinion. But Post, as I touched on, has had been part of a conglomerate over many years. As with conglomerate history, brands get neglected, and Post has suffered from that under Rail Corp's ownership in particular. Post domestic market share from 2009 to today has gone from 12% to 10.4%. And the current management put that down to basically a broken network and significant disruption to business under Rail Corp. So despite the poor performance, Post cereal business remains highly cash generative. So if we turn to slide 7, and we've just given you a snapshot here of the historical financials versus Kellogg and General Mills. I won't dwell on this slide because, in our opinion, this does not tell the full story of Post. It has underperformed, and if we move on to page 8, the real part of the story is Post is transforming. And Post is transforming from a low-growth single-category participant to a consumer products holding company, operating in the centre of the store, active nutrition and private label categories. And that is the key part of the story. And if we shift to slide 9, this is where we begin to touch on the management. Post is led by an exceptional CEO, and we've highlighted a book here called The Outsiders. If you haven't read it, I would encourage you to do so. But the gentleman now running Post as its CEO is called Bill Sturrett. He's written up in this book. It's a fantastic story of Mr. Sturrett's career and really provides you with some strong insights. But if we turn to slide 10, I will touch on Mr. Sturrett's career. He's 79 years old. He owns 1.1% of Post today. based on the shares outstanding, base salary of $1 per year, and the rest in stock options at market prices. We have detailed his stock option package there for you all to read. Stirrups' package closely aligns him with shareholders in our view. Furthermore, as we've highlighted, at age 79 and not having served as a CEO when you delve into his background since 2001, we suspect Stirrups' turnaround transformation time for post will be extremely aggressive. In terms of, if we shift to slide 11, Bill Stirrups has delivered a long history of value-enhancing transactions since he first became CEO of Ralston Purina in 1981. Of particular relevance today is both the acquisition track record and the frequent use of spin-off transactions to create shareholder value, often over short periods of time. We believe a review of these historical transactions can provide an investor a strong insight into what Stirrups may do with post on an accelerated basis, with the ultimate goal of an exit at a healthy premium. If we shift to slide 12, this is a graph showing the historical returns of Bill Stirrups' tenure at Ralston Purina. $1 invested with Stirrups when he became CEO of Ralston Purina in 1981 was worth 57 19 years later. A 20% compound return per annum, impressive by anyone's standard in our view. If we shift to slide 13, in our opinion, he's at it again. Since spin-off, he's been incredibly active. The company's repurchased 5% of shares on issue at $30.50 a share. Within the last 12 months, the company has announced 6 acquisitions totaling $1.4 billion. Not all of those acquisitions are complete yet. What we would highlight to you on this slide is pay particular attention to the prices being paid and the multiples being paid. If we turn to slide 14, this really touches on, at a high level, the transformation that is taking place, and it is taking place rapidly. You have the old Post Foods, which was a cereal maker with a declining market share in a declining market. The new Post Foods has got a stabilised market share and is now seen or expected to see an improving trend. But really, what we find quite exciting is the acquisitions he's making and where it is shifting the business. And that is, if you look at it, Attune Foods, it's in natural and organic cereals. It's in granola and snacks. Now, if we focus on the organic food and beverage market, this is clearly a growing trend. We've all seen the expansion of Whole Foods. US sales of organic food and beverages have grown from $1 billion in 1990 to $26.7 billion by 2010. So this is a trend that is going to continue. It's a trend that, by the way, is increasing the world over, and we're seeing it down here in New Zealand as well. Stirrups is moving into active nutrition, sports nutrition, weight loss, meal replacement substitutes, protein opportunities. He's also moving back into the private label business that he knows so well from Railcorp days. So he's just acquired a business, Dakota Growers, a pasta company that actually came from Glencore post their Viterra acquisition. Just acquired Golden Boy. He is moving rapidly to transform the post business. So if we turn to slide 15, what does the future hold? Well, we expect a continued roll-up following his successful public LBO model that he's used in the past. He will leverage up to achieve higher returns on equity because these businesses are highly cash generative and deliver strong cash flows. He will prune less profitable businesses, expand into related businesses that offer higher returns and growth, as you're seeing already, and expect more opportunistic, large-scale share buybacks when the market affords them opportunities. And then if we think about potential exit strategies in the future, it seems to us that one of the main competitors in the ready-to-eat cereals business, for example, a Quaker Oats, might be interested in Post in the future, or Conagra, who obviously acquired in the packaged food industry, acquired Railcorp in the end, or equally a sale to private equity. These businesses are highly cash generative. They suit private equity models, or another conglomerate or other large conglomerates, and we'll leave the listeners to think about who other conglomerates could be in that regard. If we turn to slide 16, we really have to start to think about what multiples do these businesses trade at in terms of trade sales. And we have gone back to 2000 and given you a selection of transactions that have occurred over $1 billion. We have removed out of our average calculation, please note, those multiples north of 16 times, being Pfizer's baby unit, Nestlé's acquisition of Pfizer's baby unit there, Nestlé's acquisition of the confectionery business in China, and also the Mars Wrigley transaction. Different businesses, really. So if you look at the cross-section of transactions we've highlighted there, you get an average EBITDA multiple of industry participants willing to undertake expansion or consolidation, whichever way you want to look at it, at 13 times EBITDA. So if we take that through to slide 17 and think about what is Post potentially worth on a future basis, Post is trading at 10.7 to 11.4 times adjusted EBITDA. If we think about the industry transaction average, which we've highlighted on the previous slide, 13 times EBITDA, and we start to extrapolate that across, and we say 12 to 13 times might be a fair transaction multiple for the transforming Post, you can find Post trading at a discount of 34% to 79% based on the Elevation Capital Value Fund's cost basis. Post has had a considerable run in the last 3 months, but even so, Post is trading at a discount of 12 to 51% based on a current market price as at the 16th of December of 47.33. We have detailed on the table below our high-end and low-end estimates for EBITDA based on Post guidance there, so people can look at the sensitivity across EBITDA multiples based on an Elevation Capital forecast of EBITDA for 2014. So if we move through to slide 18, and I'll conclude my remarks there, and Oliver, then welcome your questions on these slides. I guess to summarise, Post is essentially a non-traditional value investment in a Graham and Dodd sense. It's a cash flow plus stirrups equals interesting opportunity investment in our view. And Post is clearly transforming. Stirrups, with his wonderful track record, is attempting to leverage an iconic business with strong cash flows into categories that offer more rapid growth opportunities. He seems to us to be on a path to execute this transformation quickly for the benefit of all shareholders. We believe on that basis one should not be surprised to see a trade sale of Post within 2 to 3 years. But a trade sale is not the only path here, and it's not the only way to win. If Stewart executes, as he has done in the past, we may also end up with a highly cash generative and large consumer goods business that returns large amounts of capital to shareholders and in time undertakes spin-offs or other transactions to add further value. So in short, and to summarise, there are many ways to win at Post in 2014 and beyond. And with that, I'll close my remarks. Thank you very much. And Oliver, I'll turn it over to you.
Well, Chris, thank you so much for these remarks on Post Holdings. Really enjoyed them. And I'd also like to say that anybody in the audience with questions, feel free to get in touch with us in the online conference area, and we will facilitate a Q&A with Chris if you do have any further questions. Maybe I can just kick off the Q&A with a few questions of my own, Chris. I was curious, certainly in your remarks, it came across that Bill Stirritz is a big part of the investment case here, and I was curious, how would you look at this opportunity? Would you even invest in this company if Bill Stirritz was not involved? And certainly you referred to the age there as well. Kind of how do you get comfortable with that?
Thanks, Oliver. It's a very good question and something we thought about, and we looked in depth at the directors and the senior management, and Post actually has a very deep bench of talent. Interestingly enough, a lot of the talent has followed Mr. Stirritz. You have, we look at the director level, Dr. William Danforth. He was a director of Rail Corp from 94 to 99, and of Ralston Purina from 1969 until 2001, when Nestle ultimately acquired that company. So a large amount of experience there. David Scary, who's a director of Post, was a co-CEO and president of Rail Corp from 03 to 2011. Again, very experienced in the consumer industry. And then Mr. Terence Block, who's currently the President and Chief Operating Officer and a Director of Post. He was with Stirritz at Ralston Purina from 1977. So this is a deep bench of people working within the consumer industry. And I haven't dwelled on all the other people, directors and senior management, but those are the ones that spring forth to my mind in response to your question. So yes, the investment, Stirritz is a wonderful capital allocator, but he has built a good team of people around him. So I hope that answers that question for both yourself and the audience.
Certainly, it seems that there are quite a few moving parts here in terms of the transformation and kind of getting a handle on the current profitability versus potential profitability of the business. Understanding that challenge with a transformation such as this, how do you think about the, if we look at the profits today, kind of to understand the margin opportunity just from the businesses that they have today, if we disregard kind of potential acquisitions or divestments, how do you think about the margin opportunity of the existing businesses?
Well, I think you've touched on, Oliver, another way to win in this investment if you assume, one, a steady state, or two, continued acquisitions. Clearly, Post has suffered being part of a conglomerate in Rail Corp. It was neglected. Rail Corp's sales force was not as good as Kraft's sales force. That's been acknowledged in the Post spin documents. And you start to see that in the net margin. This is a very attractive gross margin business if you look at it versus peers, but it really hasn't flowed through to the net margin. So if you think about what Mr. Stirritz is doing, bolting on other businesses within the same sector, clearly that drives significant economies of scale within your sales force and other parts of your business. There's also the opportunity to rationalise plants, rationalise distribution facilities, and you're seeing that just recently they've made an announcement that they're closing a plant in California. So I think you're quite right, Oliver, to touch on it, but that's another way where you can win with this investment not just on Mr. Stewart's continuing to make acquisitions and transform Post at a rapid rate. Just a cessation of that and running the business better over a period of time and rationalising facilities could see a significant lift in profitability. And I would also touch, I guess at that point, one has to remember with the earnings is you've only got part year of earnings on a lot of these acquisitions. So I suspect in the years ahead you'll see a significantly improved earnings picture.
And you mentioned the net profits there quite low, the net margin, and one thing that has not escaped me is certainly, and others I'm sure looking at this situation, certainly value investors concerned also about downside protection is the level of debt that's been building here. So I'm curious if you mentioned there are many ways to win with this investment. I'd be curious to understand better, how do you think about downside protection with a situation like this, especially in light of the considerable debt that seems to be building up on the balance sheet?
Yeah, absolutely, and they've been on an aggressive acquisition spree and the gearing has increased considerably. First, I guess first response to that question is you have to remember that these are very strong cash flow businesses. As you make further acquisitions in the sector or just consider the acquisitions that have taken place, there's clearly rationalisation of plants, there's rationalisation of people, so there's synergies to come through that won't occur for 12 to really 24 months. Equally, if you think about our adjusted EBITDA numbers, there is only, in some cases, 7 or 8 months of earnings that are coming into the company for the 30 September 2014 year end. So the cash flow will increase significantly, the cash generation will increase significantly in the years ahead from current levels, and therefore debt isn't so much of a concern versus standing still today. Standing still today, I acknowledge that that some people could be concerned about the level of debt Mr. Sturrops has taken on to transform Post. But if you look a little bit further out and just take a reasonably conservative, and he gives you very sound guidance of what to look for in earnings going forward, you can get very comfortable with the debt burden. And come back to the fact that we are talking about one of the best capital allocators and his team of people in the history of corporate America.
Absolutely, that is certainly worth remembering here when questioning anything related to such a exceptional capital allocator. So I do want to thank you again, Chris. Unfortunately, we're going to have to end it here, but I do want to again refer anybody in the audience with further questions for Chris to get in touch in the conference area, and we'll facilitate that Q&A online with Chris. Chris also has some additional materials that we have made available in the conference area, and I would encourage everybody to read those, some background on Bill Stirritz and recent events surrounding the company and the man. Thank you, Chris, again so much for taking the time to share your insights into Post Holdings with us today.
Thank you, Oliver. Thank you very, very much.